Federal Reserve, led by Fed Chairman Jerome Powell, once again opted to hold interest rates steady at their current level.
Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures.
The move was widely anticipated and comes against the backdrop of months of hotter than preferred inflation reports. Interest rates are the main tool the central bank uses to control inflation. When interest rates are higher, demand falls, and in turn, so does inflation. Despite interest rates being at their highest level in years, inflation has still not fallen to the Fed's 2% goal. Inflation, according to the Consumer Price Index, is still clocking in at about 3.3%. Back in December, as inflation was showing progress in moderating, investors were expecting up to 6 interest rate cuts in 2024. Those expectations have shifted significantly since then given the hotter inflation prints. Fed officials are split on where interest rates will be by the end of the year, with most, though not all, thinking there will be at least one rate cut this year. The Fed has been given some ammunition to hold rates higher for longer because of underlying strength in the labor market. Despite the high interest rate environment, the jobs market has proved resilient and unemployment has remained low. But if the labor market starts to quickly soften, it could move up the timing of the first interest rate cut. The Fed will be watching all economic data closely and assessing its next moves. For the Washington Examiner, I'm Zach Halashak.